Good evening, everyone. McDonald's served up a big Happy Meal for shareholders today. It announced a $20 billion package of stock buybacks and dividends by the year 2016. Now, this new plan could give investors 20% more cash than they received during the last 3 years. The higher return comes at a time of weak company growth at the fast food company, as U.S. sales have continued to be disappointing. But despite the news, shares of McDonald's still slipped 1%. McDonald's and much of corporate America have a big appetite for buybacks, and so far this year, the stock repurchases are at lofty levels. Some Wall Street pros think buybacks have propped up the market. Is that true? And what does that mean for investors? Dominic Chu reports.
According to S&P Dow Jones Indices analyst Howard Silverblatt, corporate stock buybacks are on pace to have their second biggest quarter ever, with S&P 500 companies already reporting $157 billion in repurchases during the first quarter of 2014, and the numbers are still trickling in. Among the companies buying back the most of their own stock, oil and gas giant ExxonMobil, which bought back $4 billion worth in the first quarter, and computer services company IBM bought back $8 billion. Then there's Apple. It set a new record for the most stock ever repurchased by a company in a single quarter, by spending nearly $18 billion on its own shares. Many investors look towards buybacks as a bullish signal.
When companies announce buybacks, a lot of people say that's an important thing to consider. It's not a perfect indicator, but it's a good indicator that management believes that their stock values are so attractive that it's better than anything else they can do with that portion of their cash, which includes investing in plant and equipment and also buying other companies.
Some experts take a more cynical view. They say that buying back stocks simply reduces the amount of a company's stock outstanding in the market, and that lets them show growth in earnings per share. But not everyone thinks that the stock buybacks are the only thing driving the market.
I think that overall, share buybacks have played a role. They've helped. But I think the main thing that's driving the market is the fundamentals. We're in a modest growth, modest inflation environment. Our American companies have figured out how to make money in that environment.
Of course, a stock market at record highs is likely propelled by a variety of factors. Share repurchases of this size are a definite help. Now, the question is, will it be enough to keep the bull run going? For Nightly Business Report, I'm Dominic Chu.
Well, not many bulls on Wall Street today. All three major indexes were down, breaking a 4-day winning streak. The Dow lost 42 points, the Nasdaq was off 2, and the S&P was down 12 points. Over in the bond market, the yield on the 10-year Treasury note dropped to 2.44%. This is the biggest one-day decline since February and touching its lowest level in nearly a year.
David Lefkowitz joins us now to talk more about the markets generally. He's senior strategist at UBS Wealth Management. David, welcome. Good to have you with us.
Thanks for being here.
Let's talk a little bit about that stock buyback issue that Dominic just reported on, and whether, in fact, the fact that corporations themselves have been, I believe, the largest net buyers of equity so far this year, whether that is a sign of strength in the market or a sign that, well, we better buy because nobody else particularly wants to.
I think stock buybacks can have a short-term impact on a company's share price, but I think over the weeks and months, what's more important is the earnings per share and what that means for earnings per share growth over time. And what the buybacks do is they do reduce the share count that companies have outstanding, and that tends to boost earnings per share growth a little bit. At a market level, it has an impact of about 1 to 2% of a boost to earnings per share growth. So that's how I would think about it. It can have a little bit of a short-term impact, but over the longer term, it's beneficial in a small way for the stock market.
All right, so David, what is going to drive stocks to go higher? Okay, today was a down day. We've had some milestones recently on the S&P 500, but what's going to drive the markets? And, you know, what's your overall take on the markets for 2014 so far?
So I think what's going to drive markets is it always comes down to earnings. And earnings this year, we think will be up about 8.5%. And that's probably going to be about the type of gains we see for the market over the course of 2014. And so far, we're really pretty much on pace for that. We're up, including dividends, we're up about 4% so far this year. Annualized, you're getting close to that high single-digit number that I mentioned for earnings growth. In the first quarter, earnings came in even better than I think many people thought, growing 6%, and that's with the weather being a significant negative impact. And I think as you go forward through the rest of the year, you're going to see a pickup as the weather becomes less of a factor. In conjunction with valuation, which looks relatively normal, I think we can look to earnings to be the primary driver of market gains over the balance of the year.
Forgive me, David, if I'm being a little dense here, but let's talk about earnings growth in a context of large share buybacks. If McDonald's goes out and pulls $20 billion worth of shares out of its share count, and then a year from now, I see that its earnings per share are up X%. Are they really up X%, or is it merely that, and are the profits really growing, or am I really growing profits by reducing the number of shares over which those profits are displayed?
It's a fair question, Tyler. I think the first thing I would point out is that about half of the share of the $20 billion will go to dividends. So about half of the $20 billion will go to share repurchases. But at the end of the day, if I'm a shareholder in, say, the S&P 500, what I want to know is what will be my earnings for each share that I own in the index. And if the number of shares outstanding are going down because of corporate actions, that does tend to boost my earnings growth rate. And that's ultimately what I care about as a shareholder.
Mm-hmm. David, I want to follow up on something that you put out in a report today talking about select oversold opportunities. You mentioned a bunch of stocks, 18 stocks, everything from Facebook and Google, Yahoo to Blackstone Group, saying that many of these stocks have been oversold recently, and these are opportunities for investments, for investors. Tell us a little bit more of what your message is here.
So we put out this report because we were responding to, if you recall back a few months ago, the big momentum sell-off, and people were scratching their heads about what was causing that. And I don't think we even know essentially why stocks really fell during the months of March and April in those kind of high momentum areas of the market. So what we thought it was an interesting place to look, given that the market is at all-time highs roughly, and where should people be looking to invest right now? We thought it would make sense to look at some of those stocks that may have gotten hit in the momentum sell-off, but where fundamentals are still quite good. So we found 18 stocks where fundamentals are good in the sense that earnings estimates for these companies have actually increased over the last 3 months. They were sold off in the momentum sell-off, and our analysts like them. So that's how we came up with this list of 18 stocks.
Are you at all worried about what's going on in the bond market, with bonds now at 246 on the 10-year? What is that telling you, and what should we infer from that about the direction of stock prices?
Tyler, this is the question that everybody's talking about. And I think there have been a number of factors that are leading to the decline in bond yields. I think the factor that probably makes them has the greatest weight in my mind is that investors are beginning to price in the fact that the Fed is not going to raise rates to the extent that it usually does in a tightening cycle. So I don't think it means that the growth outlook is necessarily any worse. What it probably does mean, though, is that interest rates are not going to, the Fed is not going to raise interest rates as much as we originally thought.
All right, David,
that they were going to.
We have to leave it there. Thank you so much for being with us. David Lefkowitz at UBS Wealth Management.